So my name is Laura Ruderman. I am the CEO of the Technology Alliance, and I want to thank all of you for coming today. Just briefly, the Technology Alliance is a business-oriented nonprofit that was co-founded by, among other people, Bill Senior and Tom Alberg, to help create and maintain Washington State as a hub of the innovation economy. And we do that by focusing on three areas: education, research capacity, and entrepreneurial climate. We also bring together elected officials, the business community, and the research institutions to work on those issues. So this program today, in which we are co-hosting or co-presenting with WTIA, is part of that effort on our part to help strengthen the entrepreneurial climate in Washington State. So before we get started, I want to just do a brief couple of things. One, thank you very, very much to Madrona for hosting and providing refreshments. I was saying to Tim that I am having slight flashbacks because the last time I was in this room, we were all talking and suddenly everybody's phones started going off with messages that just for the next 2 weeks, nobody should come into the office. So that was interesting to walk back in here and be hit with that flood of memories. Of course, thanks for the WTIA, for Nick, where are you? For co-hosting this with us, thank you. I think I have thanked everybody. Have I thanked everybody? Okay, I'm terrible at thanking people. So we are, really, you can take the girl out of New York, but you just can't take the New York out of the girl. So we are hoping today to bring together founders and funders from the community to talk about accessing corporate venture capital funding, including update some of the views that people have about working with corporate VCs, and to facilitate a candid conversation about what circumstances make the most sense for founders when deciding to work with corporates, which of course is why we have asked someone who is formerly of a CVC, so that hopefully we can get the real peek behind the curtain and all the things she couldn't tell us back when she was still working at M12. And with that, let me hand it over to Tim Porter and Lisa Nelson, two people who I really enjoy working with. Tim is currently and has been for a long time on the board of the Technology Alliance. Lisa is a former board member. And of course, Tim is managing director here at Madrona, and Lisa was a co-founder of M12. Any of the rest of their bio, I figure you are not here to listen to me talk. They will bring up as it is relevant. And now I will turn it over to you guys. Thank you.
It's on. There we go. Flick it on. Great to see all of you. Thanks so much, Laura. Thanks so much for being here, Lisa. This should be really fun. Just to add a little bit of color to what Laura said, one of the initiatives Tech Alliance has been doing for the last number of years is to try to bring more corporate investment to the state of Washington through a variety of activities, connecting corporates with great startups here around certain themes that are big in the state of Washington, et cetera, et cetera. And so we would get these questions around from founders, how should I be thinking about corporate investment? And this kind of came out of that. Is like, let's talk about this more. How do I find it? How do I think about it? What are the pros and cons, et cetera? And we're really fortunate to have Lisa here with us. So not just a former CVC, but a co-founder of M12, one of the largest and most successful corporate VCs in the world. And now is involved in sort of all sides of the table. So making investments, serving on boards, a number of public company boards, Brooks Running, Astra Space, Limeade, congratulations, just got acquired. Advising a number of VC firms, Flying Fish, great firm here in town, some international VCs. So wonderful to bring all that perspectives here. As for me, I've been at Madrona for about 17 years, and before that I was at Microsoft, and so I was doing some corporate investing there and more on the M&A side, but in the pre-M12 days. And since I've been at Madrona, have had a whole bunch of companies that have worked successfully and unsuccessfully, but mostly successfully, with corporate investors from companies like Concur and In-Q-Tel and VMware and Cisco and Google and You kind of name it, have had a bunch of experiences, ups and downs. So we'll go into it a little bit here. Want to keep it super interactive. If you have any questions in particular, just raise your hand. Happy to interject, dive deeper on a point. And I guess we have about half hour to 35 minutes to go through it. So maybe we can jump in. Lisa, so co-founding M12. So Microsoft obviously had made investments for a bunch of years before that. Maybe just tell the story of what were sort of the design principles, why bring together these efforts under this new brand, M12? How did you think about doing things differently, the same, vis-a-vis what Microsoft had done historically and what maybe other people out in the industry were doing from a corporate investing perspective, if that was a factor at all in your thinking and how you put it together and built it?
Yeah, well, first of all, so great to see so many familiar faces and see some new ones as well. One thing I was noticing when Tim was talking is that he's got his iPad there and all prepared with technology, and I came with my paper printed with hand notes and everything. So hopefully that's not indicative of of our rate of adoption of technology or our viewpoints. But no, it's so great to be here. I was thrilled when Laura asked me to participate and sort of share my views because I actually have been out of corporate venture for a little while now. So, I started M12 back in 2015, actually. So it sort of stemmed from, at the time, we had gotten a new CEO, who's Satya Nadella, still the CEO today. Thankfully, he's done an amazing job for the company. But he had just, taken over as CEO, and he was really thinking about, he was very focused on sort of reinventing Microsoft, right? And like, how can we do things differently? What are the things we need to keep the same? But also like, being very honest and candid about where there's some changes that were needed and, what we could do. So he started actually what was sort of the new global business development group that still exists today. And historically, business development had been decentralized, which meant that every product group sort of had their own BD team. So Office had a BD team, Windows had a BD team, Xbox, et cetera. And when Satya came in, he's like, we have this amazing collection of assets and we have this really great brand called Microsoft. Like, why do we not have a BD team that is focused on sort of that collective portfolio and doing deals at the company level as opposed to just the product level? So out of that was born this new global business development org, and I was recruited to go over there and sort of help set up shop. And we had about 300 people around the world really thinking about, okay, how are we reinventing partnerships, and what does that mean for Microsoft in today's day and age, given the portfolio and the brand and the work that we've done? And everybody was really focused on sort of the large partners, right? Like the HPs and the Dells, or the large global SIs, the system integrators. And, while we were going through this process, I was thinking like, wow, like what an incredible opportunity to really think about also like, how do we think about partnerships with startups? And I had the benefit of being at Microsoft at that point about a dozen years or so. And I was very much under the perspective that, we're not doing a lot of innovation. I mean, it's just a huge company, right? I think at the time it was about 160,000 employees. Today, I think it sits somewhere closer to 250. But it was really like, how do we think about innovation? And it's really hard to do at a company this size and at this scale. We're great at distribution, we're great at go-to-market, but we're not really great at technology innovation. And that was sort of an overhang at Microsoft at the time. So I decided to write a white paper on why Microsoft should have a venture fund, like how to think about re-engaging with startups and doing it in a really meaningful way. So not just going in and saying, hey, we want to partner with you, let's sign a deal, we'll put you in our marketplace or something like that. But let's have skin in the game. Let's put some money in there and let's really think about like, how can we re-engage in a way that's going to be meaningful to everybody. And so that was sort of one side of the argument, if you will, in the white paper. And it was actually a very short white paper. It's only like 5 pages. And the other things that I laid out, though, I would say was really focused on three core pillars, or 3 dynamics. One was how to augment R&D. Like, what was the benefit to Microsoft? And it was to get insight into that innovation that is happening around the world that we just don't have perspective to, based in Redmond, Washington, right? And based on a number of people who had been there for 20 years, 30 years, whatever. So it was to augment R&D in a fairly efficient and cost-effective way. The second was to be, I would say, an accelerant to M&A. So not necessarily that we would invest so that we could buy the companies, but hey, if we're gonna have a team that's going out there and talking to startups and meeting startups and understanding all the new stuff that's happening, like what a great feeder back to the M&A group and the corp dev team, right? Like we can tell them what are some of the greatest things happening out there and the best teams that we're meeting. So number 2 was M&A. And then number 3 was really, I'll call it cultural disruption or cultural transformation. So how do we infuse some new thinking and some new ways of working into the organization? Microsoft has such a rich history, and as a result, many people had been there for such a long time, really tenured people. But it was a real opportunity to think about, okay, you know what, startups, they make decisions quickly. They make decisions fast. I mean, they operate with a sense of urgency that just doesn't exist in some of these really, really large organizations. So it was a way to bring some of that perspective in terms of agility and nimbleness and a sense of urgency, a different risk profile, how to think about risk in a very different way, how to bring that all into the company. So I wrote this white paper, sent it off. About 2 weeks later, I got a call and I was like, oh my God, what's happened now? I'm fired, and it said, hey, we love this idea. I should go pitch it to the board. We think it's really got some legs and, would love to see what this can become. So about 2 weeks later, 3 weeks later, M12 was born.
Awesome. If you, over time, if you flip that around and think about it as the value prop to founders, because augment R&D, accelerate M&A, culture transformation, those are all very strategic to Microsoft. And I can imagine can be many benefits to founders, but how did you think about that and make it so that this was very much a win-win for the portfolio companies you were going to look to back, as well as the benefits that Microsoft got from that partnership?
Yeah, absolutely. The purpose of the white paper was really to get the support from the company, right? And to say, hey, you're going to give you an allocation, some sort of budget to go and be able to invest. So that's why that was very Microsoft focused. In terms of the founder side, it was really thinking about, Microsoft was at this real inflection point, had done many, many great things from a technology perspective, and really had a global footprint. And so really thinking about, okay, as a startup and as a founder, how can we help you tap into that? And that being a bunch of different things, right? A collection of assets. So I would say the number one thing that startups generally want, outside of capital, of course, and we were going to be able to provide that, is customers. How do you drive revenue, right? How do you make sales? And Microsoft happens to touch almost every company in the world in some capacity. So we had this amazing customer list. And is there a way, to provide access to the startups to that customer list? So that was sort of number one, potential sales opportunities. Closely related to that, I would say, is really the opportunity to continue to refine product and test, right? So not everything is going to be some huge enterprise agreement, but are there companies on the customer list at Microsoft in their portfolio that might be interested in testing some of the new technology that might be happening in the industries we cared about? Retail was a big one, healthcare was a big one. How could we sort of show value to the startups through that, but by the way, also show value to the customers? And so it sort of becomes this three-pronged approach, right, or a stool where everybody is winning. So that was sort of the other thing for founders. And then finally, I would say, access to the deep subject matter experts at Microsoft. I mean, there are some really, really smart people there. And, if you are a startup, let's say in, I don't know, Tel Aviv or London, it might be hard to access, somebody who is the foremost subject matter expert on AI or productivity or whatever. And so through the startup fund, it was a way for us to give access to that in a very sort of programmatic, systemized way.
So I would say that in my experience, there's really three kinds of corporate investors. There's ones who are doing it only to be strategic, and whether it's accelerate their product roadmap, find M&A, some of the things you said, and maybe some others. There's some who say, hey, we're only doing this for financial returns. Yes, if we do get good financial returns, there should be some strategic things, but we want to be very almost, they sort of position themselves as more standalone, more financial only. Maybe GV, Intel, maybe they fit into those two at least, and how they. And then I think there's the more common case of like, hey, we're looking for financial returns and to be strategic to both us as the corporate and you as the portfolio company. And you just outlined a bunch of ways. I think M12 was definitely in the financial returns and strategic. How did you think about financial returns, internally? Was that a key thing that you measured yourself on? And then you can think about what that implies for the founders as well.
It was definitely something we thought about, but given the amount that we were going to be investing, it's hard. Maybe let me actually take a step back. It's hard for a company the size of Microsoft with the P&L that they have to actually make any meaningful impact from a financial perspective with an investment in a startup. Even your largest startup, right? It's going to be very hard to move the needle and have it be anything other than a rounding error. So, yes, we wanted to drive financial returns, but we knew it wasn't going to be meaningful from that perspective. It was more from the perspective of we don't want to do bad deals, and really underpinned by the philosophy or the thinking that, to drive strategic benefit, these startups have to be good. They have to be good at what they're doing, and they have to be successful. So, said another way, if you're doing bad deals, you're probably not reaping a lot of strategic benefit from that.
Yep. If you now kind of abstract, so that's great history and background for us to think about. If we abstract away a little bit, and now that you're in your role as board member, investor, et cetera, what advice do you give your companies and founders as they might have opportunities to either, pursue strategic corporate investment, or maybe they're being pursued for strategic corporate investment? Are there a set of things that everyone is different in some degree, but are there a set of things that founders should keep in mind as they're thinking about that path?
I don't know that I would say there's sort of a prescribed, checklist to go through, but, one, first and foremost, as a startup, like, understand what it is you need and what's important to you in your life cycle where you're at today. And that's just sort of a great question to always be thinking about, whether you're trying to raise money from a CVC or a VC, right? And that'll help you sort of narrow in and focus in on who could be the right partners for you. I think, particularly from a CVC perspective, it's important to understand what you had said earlier, Tim. Not all CVCs are created equally, right? They have different goals. They have different types of teams, different types of operating philosophies, different type of investment strategies. So you just have to really understand, like, what is it that's going to be most beneficial to you as a founder, as a startup, and then go find the CVCs that match that, as opposed to sort of the other way around, just going and thinking about, okay, well, I want to get an investment from Microsoft. Okay, well, why? What is it that Microsoft can provide you that's really going to help accelerate your business and help you be successful? That's the question that I always tell the companies to ask themselves. And then it's really thinking about, like, understanding, what is that CVC's goal? Like, what are they doing? What is their purpose? If it's purely strategic and you have to have a commercial partnership with them, and you're built on AWS today, are you really going to retool your entire platform and solution to be on Azure so that you can get that investment? That's a pretty big commitment, right? And so you might be doing something that's very unnatural or very costly and just not right for the company. So you have to understand, even within CVC, if somebody's strategic, like, what does that actually mean? I'll just tell you, at M12, it was strategic in the sense that we wanted to understand, bring that information back to the company because it benefited all those things I mentioned earlier, but we didn't require a commercial partnership. And in fact, we were investing in companies who are on AWS, who are on GCP, who had nothing to do with the Microsoft ecosystem as of that day, because that's really where the interesting learning was. Like, why haven't they built on Microsoft, right? What are they doing out there? And, like, what is it about our platform that wasn't suitable for them? That was really what was interesting. We didn't want to limit the sort of purview that we could get from it. But, sort of bringing it back to the question you just asked, it's just really more like understanding what is it that you need and, who fits that profile, as opposed to thinking about going out there and just talking to people and being like, okay, well, yeah, that sounds interesting, so let's get capital from them. As difficult as it is for founders at an individual level right now, capital is actually fairly abundant still. I know it doesn't always feel that way, and it's easy for me to say because I'm not raising and I'm not a founder. But it's actually fairly abundant, and that was true before, and I think it's true now. There's just some different parameters with which that capital is getting deployed. But I think, really understanding, like, what is going to make my company successful, and what is it I need today? Not 5 years down the road, not 10 years down the road. What is it I need today to get to that next phase of my company?
This point about you didn't require a commercial partnership or agreement, I think, is a really important one and something to think about. I always ask founders if they're considering or corporate investment and say, would you take this equity investment if you didn't have a commercial partnership? And if the answer is, you wouldn't, you're only taking this money to get a commercial partnership, then go get your commercial partnership. And that I feel like there's a big pitfall in trying to completely commingle, in most cases, the two things. And if the the corporate does require a commercial relationship, commercial agreement, and you don't have it yet, and now you're trying to get your fundraising done, and you're waiting for that thing to get done, good luck. And so maybe you can comment on this a little bit, Lisa, maybe from the perspective of like, so you didn't require it, but were there any best practices for what was the best way to get to some of those strategic objectives or get to a commercial partnership? Was it, hey, go get that in place with the business and then we'll decide if we're going to invest? Is it like, let's just invest and then we'll help you try to do the best way, to get it? Because even though these companies, people are obviously, hopefully pulling in the same direction, there's generally a misalignment of incentives in the sense that the commercial agreement side folks and what they're trying to drive with their business, they don't get to really benefit from if the equity makes a bunch of money. And the people that are trying to invest the equity, maybe they get some benefit, but it's just, it's related but different, right? So how did you try to help coach companies to get to their commercial goals, either with Microsoft or now as you see them trying to, your portfolio companies working with other strategics?
I think the number one thing goes back to being very clear and very realistic about what it is that you want and what it's going to take. And I would say, for sort of putting my old M12 hat on, a big piece of the guidance or advice I would give companies either before we had the deal done or even after was just like, okay, so you want a commercial partnership with Microsoft. Do you understand what that takes, right? Do you have a dedicated person? Even if you got capital, if you received capital from M12, there's still 159,995 other employees in the organization, which means it's really complex and it's really hard. And while we can help you sort of accelerate some of those things and get you, sort of push you in the right direction or get you ahead of the queue or, get the attention and get someone to call you back, it's not sort of a guarantee. You still have to have the merits of your business and why it makes sense for that division, that salesperson, whatever it might be. So that hurdle still exists. We're just getting you to the top of the queue, right? I think the next thing too is that, it's hard to manage some of these big corporate relationships. I mean, it's not just like, hey, you've got somebody and, they got an hour, a week or whatever, and that's how you're going to manage a relationship with a large corporate partner like Microsoft or Google or an Amazon. It actually, you kind of need like a dedicated person almost. There are so many different people who, despite the fact that we all work under sort of the same umbrella and have the same domain for an email address, it's hard. Not everybody talks to each other. Not everybody listens to each other, even when you're talking to them, right? And people have different incentives and different goals and different objectives. And so you kind of need almost like a full-time person, I would say, to manage some of these really large strategic partnerships. And that's the number one piece of advice I'd give. Like, do you have the resources to do this or not? Because a 10-person startup, let's say, who's not located in Washington, is probably going to have a tough time trying to manage one of these things and be successful. So that's where it just goes back to being really realistic and clear about what it is you want, and then figuring out what the steps, and if capital and sort of, that relationship with the venture arm you think could be an accelerant, that's great, but it's not going to make or break the company by any means.
Take questions anytime. I've got, we've got hours worth of content and questions here, but yeah, Nick.
Is that like an account manager, or what is that person? Sorry. Can you expound on who that person is and kind of like what the role is? Is it an account manager type person, or is it something else?
It really just depends on the company and what they're trying to get. But, for the largest startup, it could be an account manager, like a strategic account manager. I would say most startups don't have the luxury of having that role in the company, right? There's much fewer people. It could be a head of BD. It could be a head of innovation. It could be the CTO, right? So it just sort of depends on like what is that arrangement that you're trying to build. And it goes back to what I was saying earlier in terms of the benefits that you could get. If you just want to get on the sort of the reseller list, right, then it is probably somebody who's like an account manager. If you are trying to, get your product and your feature integrated into one of the main core products, then it's probably somebody who's a little bit more technical, but somebody who can have the conversations with the engineers, with the PMs, with the devs, and sort of funnel it through. I mean this in the most respectful way, but like as a startup, you kind of really need them more than they need you, just because they've got 17,000 priorities on their plate. And so the easier you can make it for them and trying to navigate that relationship, the better chance of success that you have.
So you mentioned that if a company is not located in Washington State and they're small, they're going to have a hard time. Is that because people need to get FaceTime, or because like for our team, part of us is in Washington, part of us is not in Washington. So I'm not sure like what the criteria is for being able to. Yeah.
Yeah, I was being very generic with the Washington just because that's where Microsoft is located. But the reality is, like where M12, for example, where we were investing was in the U.S. and I would say primarily West Coast, not exclusively, but it's pretty easy to travel around the U.S. for in-person meetings. Also in Europe, and then also in Israel. We generally wouldn't do deals outside of those areas because there wasn't an opportunity to meet face to face and to engage. So, yeah, I say it sort of generically, but I do think, and this is maybe where like you guys are gonna be like, oh, that's why she has paper. I still believe in the face-to-face, meetings and the relationships. And I think the more you can build a relationship, where there is trust and there is credibility and there is mutual respect, the better chance you're gonna have to be successful. And so that just requires some physical proximity at some point. And look, if you're a startup and you're based in I don't know, Northern Africa, let's say, but you really, and you're willing to travel and you have the time and you have the funds to do it, like all the resources, great. It's just that startups have so many competing priorities that it's really hard to hop on a plane every time you want to talk to your investor.
Don't worry about the paper. We need later doctors and technology as well.
Lisa, Microsoft has a great respect for intellectual property, and it has a lot of it. So did you ever have to back away from deals because of potential conflicts of interest and the entanglement of NDAs and disclosure and due diligence? Talk about the process of a small company with its light intellectual property infusing itself into an M12/Microsoft environment.
Yes, we definitely had to worry about that, and we spent a lot of time in due diligence trying to focus on that. Maybe going back, taking a step back just quickly to our operating principles and sort of the foundation with which we started. M12 was designed, even though we were investing off the balance sheet, which just basically means we weren't a separate entity, like we were all Microsoft employees and we were investing Microsoft cash. We operated pretty autonomously, I would say, from the rest of the company. And, even the name M12 doesn't have Microsoft in it, right? M obviously represents that, and that was certainly, we had roots there, and that was, our sole LP. But we really wanted to think about ourselves a little bit differently and a little bit more independent of the company. And that was really for the founders' benefit, I would say, because, often CVC can be criticized for going in and sort of, stealing the ideas of a startup, right? And so we wanted to make sure that people knew, hey, we do have this, amazing parent company that is backing us, but we're actually operating independently to alleviate some of those fears. And so, a part of our due diligence, a big part of our diligence was going around the company and being like, okay, is anybody else working on this? Now, that's really hard to do. Again, in an organization the size of 160,000 people, like you don't just sort of spam the all-employee list, right, and say, hey, who's working on this? So this is where it was really important that we had people here in the Redmond area who could go and sort of had those relationships and knew who to ask, right, and said, hey, have you heard of this? Is anybody working on this? Because we really wanted to make sure that there was no potential conflict of interest there. And by the way, it's not just about what people were working on today, it's what they could be working on. What's in the roadmap for the next 2 years? Is that going to be a conflict with this potential startup investment? It's really, really difficult problem.
I'd just add, I've found that founders in general are too paranoid about this question. And that, back to this point about these are bigger companies that have a lot of things. They're generally not out, offering to invest in companies so they can steal your ideas. You need to be smart about qualifying these things. If some random product manager who's in charge of a product that's eerily similar to yours, like emails you and says they want to meet and says, oh yeah, we might, invest or we might acquire you, that, there's different signals. But when you have M12, you have corporate development, they have to do this over and over again. I think there's bigger risk that you don't hit your commercial goals, that just because M12 or Amazon Invest doesn't mean they might not launch a competing product someday, but that's not because they stole your IP. Believe me, they could figure this stuff out without working with you. And I think that by being too paranoid on that point, you lose some of the relationship trust building. The way these deals work out is building trust-based relationships with the right people on the other side to get the go-to-market win, et cetera. So you can't be foolish about it, but I think in my experience, there's less risk there than you might think. Janice, and then I'll come back to one other question. Oh,
Hang
go
on
ahead.
one quick second. I'll just add on that, which is in addition to being a trust business, it's a relationship business, right? So the first time that a corporate venture fund goes out and sort of steals an idea from a startup, word spreads quickly. I mean, it is a small community out there, and there's no way you'd get into another deal. So you just cannot afford to do those things, at least not willingly and intentionally.
Right. So I've done a lot of these corporate VC deals, as you can imagine. One of the biggest issues that I've seen from the company side is losing the champion within the venture fund. Because they're not incented in the same way that a venture partner is in a venture fund. So you see turnover in the relationship person who's done your deal in the venture fund. How do you look at that when you're from the outside about, is that person going to be there, and what happens when I lose that person? So I'd love.
It's a great question, and I'm going to make it even harder, Janice.
Okay.
I do think this is one of the biggest risks, is that corporates have much bigger strategic things going on than their investment in you. And so lots of things change. The VC champion change, the business champion changes, their strategy around corporate VC changes. How do you think about those things?
Well, I thought you were going to answer that one too.
No, I was just going to make the question harder.
I would say, I mean, look, in the spirit of honesty and being candid, it's a huge risk, and it's more likely than not to happen. When you think about a CVC, and to your point, Janice, they're just not compensated the same way, which means, they generally don't get carry. I won't say all of them, but generally they don't get carry. They're generally compensated the same way that corporate employees are compensated. So that's number one. So it is part of their job, I would say, not part of their life profession, if you will. And so, chances are they're probably going to take another job at some point, and whether that's within the company or without. And so it's a very, very big challenge. I think the other thing too is that, there's also just a different risk profile. In large companies, you are generally not incentivized to take a lot of risk. You have an annual performance review. And that annual performance review is not based on what are you going to do for me in the next 5 to 10 years. It's based on what did you do for me these last 12 months. And venture is a long-term game, right? It's a very long-term game. And so you have to be really thoughtful as a founder about those things. Like, what is it that you want from this corporate? It goes back to what, Tim and I were talking about earlier, which is if you want a commercial partnership, go get that commercial partnership irrespective of the investment. Like, you have to be still building your business in all those same ways. And the venture investment can be hopefully an accelerant to those things, but it's not the sole thing that drives the relationship. You have to have that dedicated person, or a very person who can commit a lot of time and energy to that relationship for this very reason. So you're not reliant on the one person, but you've got your tentacles throughout the organization.
I will add to it. I won't just leave you hanging. That was a great answer. I do think it is a big risk, but it's like any relationship your company has, whether it's customer, partner, there's always risk of losing a champion. And what does that mean? And so some specific things, if it's an investment, one, it's often good, don't give a board seat. And maybe it's just an observer, or maybe it's nothing. Find ways to operationalize the help without putting long-term consequential relationship, contractual rights like board seats, et cetera. Think about, I had one longtime VC from a very large Valley-based firm once made this statement, a little bit to be controversial, but like they said, the right number of strategic investors is either 0 or 2, never 1. But so sometimes having a syndicate that you can have getting help from more than one place that can can dispel the, hey, we're really just beholden to this one strategic. Think about what's the overall ownership percentage that you're giving to the strategic VC. I don't think there's a bright line, too much, too little, it depends, but those are just things to think about. And if you have a commercial set of relationships that you're trying, it's like anything else. You have to try to operationalize it beyond your champion. If it's a go-to-market thing, how many people in the sales and the channel are all working on it, and it's not just, hey, this is Lisa's thing. And, so those are kind of general things, but I think there's a higher premium on really focusing there if you want to mitigate that risk and maximize the benefit that you hope to get from working and taking investment from that corporate.
Yeah, I think there's another piece to this, which is quite important when it comes to financing strategy, because what happens when you lose the strategic value, the company has gone in the other direction and no longer is it a strategic priority for them. And yet it's hinging on your strategic priority as a company. And now they're not going to put money into follow-on rounds. because they've left behind whatever that was, right? Flavor of the day, whatever. So how do you think about that as it relates to funding risk for you as a CEO moving forward?
Another good consideration for sure. I think there's a higher risk that you might not have that follow-on money there. On the other hand, if the strategic relationship remains strong, you might be in a mode where it's hard to get an independent VC to put more money in, and the strategic is still all in. And so there's actually ways that that can be a good thing. There can be ways that it's a bad thing. I would say that if this strategic investor changes strategy or you change strategy, so that I think you don't get docked as much there if the strategic didn't invest in the next round as if your like core 1 or 2 VCs have walked away. The signaling downside is not as big because there are natural reasons why that might have occurred, not just, hey, I actually lost faith and this is a good business, but I'm just afraid to tell you that.
Unless it's market risk that looks like it's at risk.
Yep. All right, I'm going to ask one question, and I know there's some more here. So decision making. So I know as founders, it's sort of like any sales cycle. It's like, how do I get this thing done? Like, when do we get to the end? And VCs are often not good at having long, open-ended diligence processes. I know we can be guilty on that, but at least you kind of know that there's a relatively small group of people that when they decide to make the investment's going to happen. Sometimes with a strategic, it's harder to understand, like, well, who is actually deciding? You know, I think you should describe it, Lisa, but M12 was very autonomous. You all decided, you make the investment, it's done. Other cases, it might be, you know, the investment team wants to decide, but now they got to go ask the CEO, and she's got 6 other priorities, or I got to ask the CFO. And what was your decision-making process, including how you weigh all those things you were trying to get out of it? Right? And so you were sort of looking at the merits of the company, you were thinking about what it meant for Microsoft, and then you had to come to a decision. I don't know, help enlighten sort of that decision-making process and how founders should think about that.
Yeah, I think in terms of investment decision-making process, you know, it's not a very satisfying answer, but again, all CVCs are created differently. So it's really incumbent upon the founders and the startups to do their research and understand what that is like. And again, the world is pretty small, so all you have to do is go to one of the portfolio companies that they've already invested in and ask them about that process. But, you know, in general, I would say for M12, because we were really cognizant and thoughtful about some of these criticisms of CVC, and we really wanted to do it in a new way, the right way, in a way that we thought was going to benefit the founders the most, because if it benefited the founders, then it would benefit Microsoft, right? So we had an investment committee that was only made up of people from the M12 team. So, you know, yes, we were Microsoft employees, but we worked in M12 and our sole focus was the venture fund. So I think there were 5 or 6 of us on the investment committee. Importantly, you know, to note that that investment committee did not include people from the product groups. So we didn't have to have buy-in from, say, Office or from Windows or whoever we might be investing in on the product side. You know, certainly as part of the diligence, we would go ask them for their feedback. Have you seen this company? Do you know what they're doing? What do you think about this technology? Give us your perspective on the market and the future opportunity. But it was one input of many that we would take into consideration when making the investment. But the team or the product group did not have a say in whether or not we did the investment. And as you can imagine, that was a little bit disruptive and it was a little bit different. It could be an irritant, a small one or a big one, depending on, you know, what we were doing and sort of who we were working with. But, you know, going back to sort of those 3 pillars, it was part of that cultural transformation, right? Sometimes a little bit of conflict can be healthy. Sometimes it can push people in directions and, you know, ways that are actually beneficial for everybody. And, you know, that certainly wasn't our intent, but there were times that it happened. And it was really important that we had sort of top executive buy-in. And so in this case, it was the CEO and sort of the most senior leadership team. They believed in M12. They believed in this idea of investing in startups and infusing some of that thinking and going and looking for new things and augmenting R&D. And so that was really helpful, because if we were an irritant to somebody, you know, a PM or an engineer, it would be like, okay, but we'll help you understand why we're doing this. And oh, by the way, like everybody has sort of seen the value in this, and that's sort of the purpose of the fund. And so I think it's really important just to understand those dynamics. I will say that there are CVCs who you have to have buy-in from the product groups. You have to have, you know, an approval. They get a vote on whether or not you're going to do that deal. And that's just where it's really important that you understand it's not necessarily a bad thing, but you need to make sure that it fits within what you're trying to achieve.
So really qualify out what the decision-making process and who the decision makers are to kind of get to yes. So how many times have we heard, oh, I've got strategic company X and they're going to invest, but they don't lead. They don't price. They don't lead. Need somebody else to lead. I think M12 led. Maybe talk about how you thought about that, and then maybe any general advice for companies. How do you deal with that? I've got a strategic. They want to invest. I just have to get somebody to lead first.
I would say the general advice on that, sort of starting with the latter part of your question, is sort of the same, I would say, with the VC, right? They're like, oh, yeah, we're interested. Find some other folks. Okay, well, you're obviously not that interested then, right? Like you got to close the deal. And so my advice would be the same, which is, one, you should never be reliant just upon one party. Right, you should be diversifying your cap table. You should have a bunch of folks involved in the round because it's also going to benefit you the most in the long run, not just from the capital perspective, but sort of all the other benefits and access and network that they can provide you. I think that's really important. What was the first part of your question, Tim?
How did M12 approach it? Did you lead?
We did lead, yeah. So, I would say we led probably 30% of the time, maybe a third. And so our focus was seed, Series A and Series B deals. And we would certainly lead where we felt like, we were just a great investor for that company. We could be a great partner for them, and we could really add a lot of value, either because we had the core competency as a company, because our customer base and sort of the access and ability, to help them was just going to be unmatched and unparalleled. So that's sort of 2/3 of the time we didn't lead. But we'd had great partners, and, hopefully we'd built a wonderful relationship and sort of reputation. And so Madrona might come to us and say, hey, we've got this amazing company. We're going to be investing. Do you want to participate in the round? And same was true. So it was really important when we started the fund, we recruited a bunch of investors who had those relationships. And had the track record so that when they did have great deals, they would come to us and sort of, help with the deal flow. And so it's very circuitous, if you will. But I think, again, going back, it's all based on trust and reputation.
Awesome.
We have time for maybe one more that I know we're not going to get to all of them, but then we'll bring it back up to Laura. And just real quick, can we just have a show of hands who in the room is a founder? I think this is helpful context. So I just wanted to start there, and then we have one more question here, and then we'll give it back to Tim and Laura.
John, yeah. My name is Jeff Zeke. I'm CEO and founder of Ergo AI. We're an insurtech company that does vehicle safety, security, and insurance telematics. We have talked with several large insurance companies' venture arms. We've been very hesitant about engaging them, because we do, in the future, we want to be completely insurance agnostic. We cannot be now because there's no standards in the industry, okay? But if we link up with one insurance company or venture fund, what are your thoughts on us being tied in to one company and not be able to offer our services to other companies in the same space? And this is a big problem for us. Hypothetically, we haven't actually engaged anyone yet, but we have been in discussions with at least 5 insurance-based venture funds, primarily in the US, one in Europe and Switzerland. What are your thoughts on that? I mean, in Microsoft, it's really not a corollary, but for us, it's a big problem, and we don't want to be locked into one insurance company and providing to one company where the industry is so competitive and we want to be able to change the industry, because what we do isn't being done in the insurance industry right now. And we'll be the first one to be able to provide it.
It's a great question, and this is a good topic that we wanted to hit on. It's, are there terms that might come with strategic investment that somehow have a chilling effect on your business that you didn't necessarily intend or don't want? And so I would say, in general, you just have to be wary of this. I think that if you're working with a very established, sophisticated CVC like an M12, et cetera, they realize that putting restrictive commercial terms or terms that restrict exit of the company makes other companies not want to work with them, and it's not very scalable or repeatable. And so I think, since I was at Microsoft 17 years ago, I've seen less and less where somebody says, hey, we want to invest, but we get exclusivity, we get a ROFR on exit, we get, blah, 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 blah. Still happens, though. And of course, each market it depends. Like, how strategic is this, to the partner you're trying to work with? So I guess I would just think about it from a few perspectives. One, from your customer perspective, first and foremost. And if the strategic is somehow asking for terms that you think limits the value prop that you can provide broadly to your customers, you have to ask yourself why, and what are you getting in exchange for that? Are you getting super turbocharged distribution, et cetera, so that you could cut off access to some other competitors? Maybe, but probably not. The next one is, so customer perspective, partner perspective. Are you doing something that precludes you from doing things with other partners, whether there's terms in place or just the perception of, hey, I'm not going to work with company X because they're working with company Y? And then the last, from an exit perspective, is there anything that's happening that is going to chill this? And so don't create toxic, restrictive terms. Think about how would this, are there terms or otherwise that would impact someday when we want to exit? Those are all the things that would think about. And yeah, there's certainly some markets that you're like, yeah, I'm not going to go exclusive or choose a dance partner, with one of these. And then there can be others where, working with one or two, you can get a whole bunch of advantages, and you can do it in a way that doesn't, restrict access to some of these other pieces.
The only thing I would add to that, or sort of on top of it, is, if they place a limitation on who else can be on the cap table in terms of other strategics, so maybe slightly counterintuitive to people's perceptions, but a lot of CVCs, they're investing as part of a syndicate, right? They're investing with other investors, and sometimes those other investors can be other strategics. So for example, at M12, we invested alongside, we did several deals where it was the Madronas of the world and traditional VCs, but also GV might be in there, Google Ventures, or AWS, or Salesforce Ventures, or Cisco, right? So people who might be considered a competitor sort of on the core business of Microsoft as a whole, but in terms of investment in the startup, everyone's sort of driving for the same thing in some capacity. And so if they're willing to let you invest alongside, hey, we're going to bring in this one insurance VC, but by the way, we've got another, is everybody okay with that? That's a great signal right there. And if they say no, absolutely not, that's an opportunity for you to dig in and better understand some of the potential dynamics that Tim talked about.
We'll take one more quick question, and then we're going to hand it to Laura for last question. We'll go a little long, and Lindsay won't get in too much trouble here. Doug, I know you'd have your hand up.
I can't hear you online without that.
Question about metrics, and you guys are playing M12 specifically in the hybrid world of both financial and strategic. So post-acquisition or investment, is there a scorecard? Are the people that are leading the deal being tracked against the economic returns and value, or the strategic momentum? So relative to secondary rounds or momentum in the strategic, is tracking with some sort of scorecard how company X is performing?
Definitely tracking. So just to clarify, tracking post-investment, not post-acquisition, right? Because that wasn't part of the strategy per se, at least for the M12 group, even though we could be an accelerant to the corporate development team who is doing M&A. But yes, there was a scorecard, or sort of a performance assessment for the investors, and it was many of the things that you'd mentioned and many of the things you'd think about, right? What has the valuation of this company done since then, since we invested? What does that look like? What are the sort of strategic benefits we've been able to bring back to Microsoft? Has there been a commercial partnership that's been signed? Have they been added to the reseller list? Has their product or been integrated as a feature or functionality of one of the existing ones? So looking at it from all sides, not just the founder and the startup success, but also the Microsoft success as well. Now, the thing of it is, though, sort of what I was saying earlier, right, is that VC is a very long-term proposition, and there's a long horizon, and that obviously gets longer the earlier stage you go. So we were investing in seed Series A and Series B, so sort of depending the time frame for a potential exit or liquidity event is sort of 3 to 6 years, maybe 3 to 7 years at those stages, and because you're doing annual performance evaluations, it's very hard to sort of gauge those things. And so it's really around, we also track deal flow, how many startups are you talking to? Because even though there isn't an investment done on every single one, there's a lot of signal and insight that can be had just from the deal flow process. And so that was another metric that we use, how many startups did you talk to? What was sort of the information you brought back, and how did you disseminate that within Microsoft? It's no good if that insight stays within the M12 team of, the 20 of us or whatever. We actually have to go and deliver that, share that information with the rest of the organization. And so those were some of the other things that we put on the scorecard as well.
Just not IP.
Just not IP.
Good question. Laura,
So,
bring us home.
so I'm going to ask a question that you guys know is near and dear to my heart, but I also know you guys care a lot about, which is diversity around who gets funded, the demographics of who gets funded, and that we approached it for very many years as women and underrepresented minorities were not getting funded because there was something wrong with them. And if we just gave them enough training, that would all get fixed. And then we started to figure out, well, maybe it's about who's writing the checks, right? And actually, both of you have participated on another panel that we did around that. We also know that CVCs tend to have more diversity around who's writing the checks because they're more around corporate demographics than investor demographics. Do you see a difference and advantage for women and underrepresented minorities in coming to a CVC rather than a traditional VC, or does any of that get lost in the noise of all of this other stuff that you're talking around the strategy of the CVC? How does that any of that play with each other? I think that question makes sense.
I think it does, and I'll obviously just answer it from the CVC perspective. I'll say, look, if the parent company of the CVC is one where diversity and inclusion is a top agenda item, which it should be for every company, but it's not, that's a great starting point, right? Because that's going to infuse itself throughout the organization, and everybody should be held accountable no matter what team they're in, including the CVC. So that's sort of first and foremost. I would say separately or sort of beyond that, again, it sort of goes back and it's different for every CVC because some CVCs are going to recruit, externally, right? So people who have that investing track record, who have those relationships, and who can bring sort of the deal flow in. That's not always the case, though. And in CVC, there's actually more of an opportunity for people who haven't grown up in the investor sort of VC world to become VCs, right, to go work in that corporate venture. And you can start, I'll give you a great example. Adam Kokari, who was on the M12 team, we recruited him out of the Azure team, and he headed up what we called portfolio development, which is basically, I think teams call it, a lot of VCs call it platform, but it's sort of the value add function of the venture fund. He is now running Intuit Ventures. I mean, absolutely amazing, right? So he was running the platform side of things and thinking about how do we help provide in a programmatic and systematic way these benefits to these VCs, and now all of a sudden he's running Intuit. So it's sort of a different path, I guess, into VC, whereas in my experience, VC has been very traditional, like you start as an associate and you sort of work your way up the ladder, and so it's more of a VC career as opposed to you sort of did something else and you came into VC. That's obviously not the case and always the case. And Tim had talked about being an operator at Microsoft, but in my experience, that has often been the case. And so I think that's sometimes limiting because you sort of make your bets very early on in your career, whereas in CVC, you can have done different things. And it's a little bit, it's still an opportunity to diversify your skill set and experiences.
I agree with everything Lisa said. I think that it does depend. I think it's not a broad, all CVCs are more diverse than all VC firms, and thus it's easier to get funding. I definitely agree with the getting in as an investor, because a benefit of the faster pace of change in some of these roles and that people go out into the business, back into the business, I think there are more slots that open up more frequently versus the traditional venture, hey, you raise this fund, you're on the hook for it for 10 to 12 years, you have signed up as the key person, key people, blah, 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 blah. In terms of getting funding, I think it can depend broadly, but definitely aligning towards, companies that have this in their values, I think that's a great idea. And I think there are many VC, I wish there were more, that had that as part of kind of their core strategic objective also, but they're probably not quite as many.
I think the other thing too, I'll just add is that, CVC is a little bit newer, and I think like the number of funds is really exploded in the last, let's call it decade, whereas the number of VC funds hasn't had that same number of growth in terms of funds and the number of positions, right? So just sort of by math, there are more opportunities there are more roles, and so there's an opportunity to recruit somebody who, maybe looks different or has a different sort of background and history than what we've traditionally done.
One addendum on that, I'd say what's happened in VC over the last 5-10 years is that there's been an explosion at new small seed funds that have like every flavor of possible theme, team, etc. Like there's more of them. But then on the bigger later stage funds, the big ones keep getting bigger. And so it's a little bit of this barbell that there's more on one end and arguably even more concentration in some really big firms on the bigger end. I both agree, it depending on your stage, it might become easier or harder.
Two of you. Sorry, I was going to say, any closing thoughts from the two of you before we release the networkers?
I'll just say, I mean, I love this title, right? Sort of demystifying CVC. I think, back in the day, there was a very prominent VC who said, corporate venture is the devil. And so I think as a result of that, sort of all these myths have been propagated over time. But if everybody who wore red was the devil, we'd have a much bigger problem. But no, look, I mean, I think, there are these myths out there, and I don't know if, they're founded, maybe they were at some time and they sort of just took on a life of their own. But, similar to VC, I would say there's good and there's bad, and it's incumbent upon you to do the research. And, there's no shortage of opportunity to sort of do your diligence and talk to folks, talk to founders, talk to other investors, et cetera. And you can quickly learn, who's good and who's not. And I would just say, that applies to VC and that applies to CVC as well. And so don't rule it out, because they can really, really be an accelerant to your business. And it's a huge opportunity, and I think one that sort of differentiates them from VC.
Well said. Thank you so much. I would just add, I hope this was helpful. Really the only goal was to demystify, and hopefully we made a little bit of progress towards that. I think corporates are an excellent source of capital. One takeaway here is the specifics always matter, but in general, it's an excellent thing that you should be thinking about in your strategic roadmap and playbook for how you raise capital, how you partner, how you acquire customers. Have had great experiences working with corporates over the years, and keep in mind the shameless plug, Tech Alliance is a good source, to make connections. Been doing this for a long time, and I've made connections from my companies with strategic had no relationship with, other than somehow Lindsay and Nick and Laura and Joe got them interested in coming here and meeting companies in area X. And so kind of keep that in the back of your mind, tell your friends, and really doing a nice job of trying to grow that pipeline of capital to help all of you and here in the state. That part is state of Washington specific.
Well, thank you for that shameless plug. Can we give Tim and Lisa just one more round of applause for taking their time and doing this? Thank you, guys. And thank you for that shameless plug, because one of the things that we do is this Corporate Venture Connection series, where we matchmake founders with CVCs. So I think at least I've seen one or two of you in this room who've gotten meetings with CVCs through that process. The next one that will be coming up in September is around fintech. And then the next one that comes up after that will be likely around AR, VR. We do a 90-minute public event on Zoom where you get to hear from CVCs in the space. And then and this is a big if, because there is a number of people who don't, a number of companies who don't. If you apply for a meeting, we will vet your company to get a one-on-one meeting with a CVC. And so we have a couple of folks who are, maybe there's one who's on the verge of actually getting funded from one of our early ones. So we're not in the meeting, and we don't guarantee results, but you can't win if you don't play. And so please take a look out. We're hoping to get up to be doing these about one a month in a different topic. So whether it's an event that's in your area so that you learn specifically about your particular area and apply for a meeting, or it's also a great opportunity to do some networking with other founders. We do breakouts afterwards. I would encourage you to come to all of them, whether it's in your area or not. So with that, I'm happy to answer questions. Nick Nelson is our program manager in the back who runs that program, and Lindsay works on that as well from the Moonbeam side. And then we have a number of board members, TA board members. Could you raise your hands? Joe, Matt, Tim can also answer questions about that program. But other than that, please enjoy. There are refreshments by Madrona in the kitchen. So go network away.